Aloha, this is Paul Brewbaker, Principal of TZ Economics in Kailua, Hawaii. I'm doing a series of short videos on aspects of the Hawaii economy, leaving 2025 and moving into 2026. This particular segment will be focused on tourism performance and some of its legacies for the post-pandemic 2020s Hawaii economy. Post-pandemic Hawaii tourism has failed to return to the pre-pandemic trend, and that's costing Hawaii. Now, some people think that's a good thing. Whatever, you get what you vote for. So here we go. If you look at domestic visitor days, so visitor arrivals times length of stay, pre-pandemic, and this is the pre-pandemic trend, pre-pandemic, things were basically around trend, sometimes below, sometimes above. Then came the COVID event. And then for the domestic traveler came what sometimes is called the revenge travel surge. So people were trapped in their houses for a year or two. Once the COVID vaccines became available, having received generous federal fiscal support, and just wanting to break out after a year or two of hiding out in a cave. This revenge travel surge in Hawaii was real. It happened in the domestic market segment, a big surge in domestic visitor, a million visitor days above trend each month. These are monthly data. A million additional visitor days per month at the peak, and certainly an average of about a half million, going from 5.5 to 6 on trend. And then came a dissipation followed by or punctuated by the Maui wildfires. Now, domestic visitor days have remained or returned to trend in the wake of the wildfires. So there's something to be said for that. Domestic visitors historically tend not to spend as much money each day a visitor is here, as their international counterparts. And therein lies part of the problem. The other part of which is whether this can be sustained in the remainder of the 20s, even in the domestic segment. Had some trouble with that, looking pretty good as of November. The big problem's on the international side. So we went from 2 million visitor days, 2 million international visitor days, Japanese, Canadians, Australians, etc. We went from 2 million international visitor days pre-pandemic to 0. And then after recovery, got stuck at 1 million. So we're missing a million visitor days. And this challenge of being unable to retrieve those international visitor days means that the domestic market segment's doing all the heavy lifting. If you take passenger counts, as it's possible to do on a daily basis, and measure relative to trend through early January of this year, so these data are about a week old, you see a striking pattern of adherence to trend in the pre-pandemic interval. The shutdown, of course, with 6 months of 14-day quarantines, followed by institution of pre-flight testing protocols that enabled tourism travel to Hawaii. In this case, these are passenger arrivals, to recover in spite of COVID variants, the Alpha, the Delta, the Omicron variant. You can see all had an impact on further delaying recovery that was occurring on its own. And then right here in 2022, right in the middle of this revenge travel surge, things began to unravel. And since 2022, so for basically 3 or 4 consecutive years, passenger arrivals have fallen further and further behind the trend of the 2010s. Now, resilience means returning to trend in a dynamic macroeconomy. So not getting back to trend means we're falling further and further behind where we could be. We have the capacity to sustain this trend, and not having done so in the first half of the 20 teens, after this tipping point right here, around 2022, around the revenge travel, we kind of almost got back and then fell away. That risk of persistence uh, means that we could be stuck for a while if we aren't permanently condemned to what we might call a negative resilience trap. One of the reasons to be concerned about this is state government policy actually in the 2020s actually set out as a goal fewer visitors. This is a screen grab from page 22 of the Oahu Destination Management Action Plan of the Hawaii Tourism Authority. Here's the link. So this is the actual policy of the state embraced in 2021 to decrease the total number of visitors to Oahu, which is about half of the overall tourism volume, through 2024, and a new plan was developed last year. It hasn't been released. They're in the final preparation of the of the next round, presumably 2025 to 2028 or something like that. The point here is that less tourism is the policy of the state of Hawaii, and it's working. If you look at visitor expenditure, which is what really matters, right? How much they spend on a quarterly basis. Again, here's the 20-year trend from the early 2000s and the 20 teens, punctuated by the dot-com recession in 2001, the Great Recession and financial crisis of 2008, 2009, these other various events like the SARS episode in 2003, the Northeast Japan seismic event in 2010, an overshoot with the subprime bubble we talked about earlier. If you look at visitor expenditures adjusted for inflation over the last 25 years, you can see that we're just not getting back. We're foregoing a dramatic shortfall relative to trend, which, if you do the same math we did with passengers, allow you to add up these amounts, right? The integral of this yellow area, for example, is, we could call this the loss associated with COVID-19. When I say loss, I mean foregone tourism export income. And then we can segregate that, maybe we should, from losses exacerbated by the Maui wildfire. But the point here is that wildfires in August 2023. But the point here is that whether the adverse event is here at time t0 or is here at time t1, this persistent shortfall, and these are in billions of constant dollars per quarter. So 1 to 1.25 billion per quarter, all that 4 to 5 billion per year. The persistence of that shortfall means that everything that we could have done if we had an additional 4 or 5 billion in export receipts and the jobs and the business volumes that came from that, the tax revenues that could have funded the infrastructure investments that would have been associated with that, that those are foregone as well. And we can add them up, as I say, we can, calculate the integrals and see that that 35 billion was foregone from the pandemic through this, in this interval time T0 to T1. And then a secondary loss of 10 or 11 billion is associated with the interval since the Maui wildfires. And there's a lot of detail here you're welcome to check out on your own. Get a copy of the PDF from me. I'd be happy to email that to you. And you saw my email address on the opening slide, maybe, so go back and look at that. Paul Brewbaker at tzeconomics.com. This does have economy-wide impacts. So as you fall away from trend in tourism performance, as you persist below your potential, operating Hawaii's operating on its potential in a dynamic way. It's sticking to the path, right? Resilience is about getting back to the path. So Hawaii was resilient in the 20 teens, not so much in the 2020s. What that means is that other things are going to reflect the adverse consequences. And these are Hawaii general fund revenues adjusted for inflation. But the point is, there's a downward trend here with and without Trump. There's been a downward trend. That's the problem of having these um, shocks like the pandemic overlap with maybe a shift in policy that strategically is adverse to the economic interests of the populace. And when you put the two together, you just screwed over. I mean, the recovery fails uh, to complete, and you end up in a shortfall from a resilient trajectory. Now, these impulses, like the COVID shock, have a wave-like response, or an adverse wave of impacts propagating outward, right, radiating outward from the zone of impact or the moment of impact. And they can have complex forms. They can be oscillatory. For example, we see an oscillation in sea surface temperatures in the South Pacific that helps us understand whether there's a La Nina or a an El Nino. And there are constraints, for example, in construction that lead construction activity for lead investment activity to be cyclical. But these black swans, like the exogenous shock of the pandemic itself in the early 2020s, can be associated with various structural factors that lead to persistent shortfall. And in the case of in the case of housing, we saw that remote work has created a shift in the pattern, in the spatial pattern of housing demand. But for the economy as a whole, because of limitations on Hawaii's tourism recovery, both natural and artificial, the um, persistence of a tourism shortfall is now showing up in macroeconomic shortfalls, like the state's general fund revenue, like failure of the state's general fund revenue stream to grow at all. I mean, it's been falling for 3 years. And you see that in overall GDP per capita in a very striking fashion. In 2017, and for virtually all of the 20 teens preceding 2017, per capita real GDP in 2017 dollars was identical to that of the US, about 60,000, up from 55,000 in the early 20 teens to 20 teens to 60,000. Then Hawaii began to falter in the late 20 teens. That's a Hawaii thing. That's something Hawaii did to itself. Maybe that's anti-tourism denialism. Maybe it's anti-science denialism, right? We dismantle telescopes in Hawaii. We don't build telescopes in Hawaii now. So for whatever reason, Hawaii began to falter. Hawaii got on the off-ramp of this resilient trajectory that the US, after the pandemic, was able to return to. Hawaii, which got hit harder because of its tourism vulnerabilities, was not as resilient in the post-pandemic recovery, and now has been subjected to what appears to be a permanent, if you take the state of Hawaii's official real GDP forecast into account, which looks to be a permanent $5 to $7 billion, I'm sorry, 5 to 7,000 constant dollar shortfall relative to the national average. Now, let me tell you, 50 years ago, when I graduated from high school, when I was in college, Hawaii per capita GDP was 30% higher than the national average. Not equal to the national average, 30% higher than the national average in the mid 1970s. And today, it's 5 or 10% lower. So you tell me if this is a good outcome. Among the 50 states, Hawaii's been among the lowest performing in real GDP overall. real GDP growth, whether you index to the 2017 moment or Hawaii got on an off ramp. And yeah, some states did worse. There's at least one, I think this is Alaska. Alaska's had a tough run, but 47 or 48 other states have done better than Hawaii, whether you benchmark to 2017 or whether you benchmark to the immediate pre-pandemic year 2019. Okay, that's being last place is a problem. And being last place when in the broad sweep of history, per capita GDP has grown relatively steadily for the entirety of the 250 years of US history, and certainly the 200 years since the Industrial Revolution began. These are per capita GDP in constant dollars with about a 2% growth rate drawn through it here. And in particular, this post-war period from about 1950 to right before the Great Recession in 2007, onset in December 2007, that period of growth um, is probably a reasonable benchmark for what we could expect in the future. Now, the U.S. has failed to make up uh, the uh, the loss it was subjected to in the Great Recession, and that's a problem. And there's a literature about that you can check out. There's a link here to a great paper by Marcus Brunermeyer. Actually, it's not a link, but it's a citation. But if you go back even further, um, I think it's important if anybody's accepting the fact that Hawaii is not going to grow uh, to enough to make up the difference between U.S. and Hawaii average or per capita GDP. Just remember, if America were to continue to grow on this 2% path, we'd be looking, and these are today's dollars, 86,000, right? Call it 80,000 in Hawaii, 78,000 in Hawaii, but 86,000 in 2024 nationwide in $2024. I mean, in current dollars in 2024, but in constant dollars, if you do this in real terms, we ought to have per capita income that's 100,000 by 2050, 150,000 by 400,000. Can you imagine if in constant dollars income was 400,000 per person by 2100? That's a lot of additional wealth. That's more than just everybody gets a smartphone. That's enough productivity for us to do a lot of good for the world and for people in it. And so don't dismiss the fact that falling short is both a short to medium term problem as well as a potential longer term problem. And I'll stop there at this part and see you on the next one. Aloha.